And I just want to reiterate Mark's welcome to all of you for joining us today. I think this is a great event and it's already off to a great start. So I just want to introduce our panelists. So we are very lucky to have Jonathan Coslet, who is the Chief Investment Officer of TPG Capital, the chairman of its investment committee and a member of TPG Holdings Executive Committee. He also serves on SIEPR's advisory board and executive committee. Jonathan received his bachelor's degree in economics and finance from the Wharton School at the University of Pennsylvania, where he was a valedictorian, and his MBA from Harvard Business School, where he was a Baker Scholar. We also have joining us Gabriel Petek. Gabe is a CFA and a managing director and sector leader in the United States group of the U.S. Public Finance Division of S&P Global Ratings in San Francisco. Gabe is S&P Global Ratings primary analyst for the states of California and Illinois. And Gabe holds a master's in public policy from the Harvard University's Kennedy School of Government and earned his bachelor's degree magna cum laude in political science from Loyola Marymount University, where he was awarded the Stanley Chan Award, given to the top political science scholar as recognized by the faculty. So why don't you join me up on stage? And I'm going to hand it over to Jonathan in a minute. So the purpose of our session is to explore both the likelihood and the impacts of a recession in California. We want to kind of talk about the implications, what research needs to be done, and what policies should be explored. And so what we're going to do is we're going to have about 12 minutes of remarks from both Jonathan and Gabe. We'll then have about 12 to 15 minutes of moderated Q&A, and then we'll turn it over to the audience for hopefully about 15 to 20 minutes of questions from you. So with that, I'll hand it over to Jonathan.
Thanks, Gopi. Mic on? Okay, great. So if we're going to talk about what's going to happen in the state of California, we have to start with what happens in the country. And these pictures up here depict two very different states of mind that we should be having right now. On the one hand, the economy in the United States is very, very healthy. It's very, very strong, and that's awesome. On the other hand, I think we do have to think about the possibility and the likelihood that we'll have some kind of economic downturn in the next several years. And that's because economies are about cycles. The gray line is the long-term secular trend. The blue line is the cycle which is caused not by stock markets, not by trade battles per se. It's caused by human behavior. In good times, like we're in now, people start to stretch, they take more risk, they buy that more expensive car or more expensive house, they do it with a little bit more debt, they take on more than they can take on, interest rates rise, and they realize that they've stretched too far and the world needs to reset. That's the natural human behavior that happens all the time, and that will happen again. It's just a matter of when and in what kind of severity. So as an investor, the thing that I'm always asking myself is when will we have the next economic downturn? And when we do that as an investor, how much will equity values decline during that period of time? It's been an amazing recovery. We are now probably about to hit the longest recovery that the US has ever seen. But as you can see, it's been a shallow recovery. It's been about a 2% GDP recovery over the last 9 years. Good news is that this year we've had a 4% GDP growth in the first quarter and a 3.5% GDP growth in the second quarter. That was partially caused by tax reform and very much caused by a lot of monetary stimulus. And speaking about that, we can never forget that the strong economy over the last 35 years and the strong asset prices and equity markets over the last 35 years is because of the very, very significant decline in interest rates from the early 1980s when Secretary Schultz and others were working to break inflation. And as you can see, we're now in a spot where for the last 8 or 9 years, real interest rates have actually been negative. So it actually pays to borrow. And that is turning. And as a result of the strong economy we've been in, we've had 250,000 jobs in the country today, this past month. That's superb. You can see the unemployment rate at 3.7% is the lowest it's been in 48 years. And interestingly, there's now more job openings than there are unemployed workers. And all of that has led to an economy and to a state where the US households now have $100 trillion of net worth, $100 trillion of net worth. You can see how much higher that is than at the peak in 2007. So that's all fantastic. That's all great news. And interestingly, even though the economy has been a relatively anemic recovery from historical purposes, historical perspective, you can see that the corporate recovery in earnings has been one of the strongest. We'll talk about that more. We're talking about third quarter earnings for US corporations of about 8% revenue growth and 20% earnings growth. About 5 points of that is the one-time effect of tax reform, but 8% revenue growth is superb, and even 15% earnings growth, excluding the one-time impact of tax reform, is also superb. I could put up another 50 charts around how good the economy is right now, and indisputably it is very, very strong on all these measures. Jobs, households, the banks are in great position, inflation is moderate, interest rates are still very low from a real perspective. Very, very healthy. So that's the good news. The next question is, what will be the catalyst that caused the next recession? What do we need to watch out for? What are the issues? Well, the most important to think about is corporate margins and wage pressure that's starting to pick up. So this is a somewhat complex chart, but it basically shows that over the last 20 years, corporations have gained bargaining power over the employee, over the laborers, and as you can see, corporate share of GDP is the highest it's ever been, and the labor share of GDP is the lowest it's ever been. That's been good for corporates, that's been good for margins, that's been good for equity prices. It hasn't been particularly good for real wages. Finally, we're starting to see some pickup in real wages, just about 3%, still very low from a historical perspective at this stage in the recovery. And something called the Phillips curve shows that when you get to these types of unemployment rates of under 4%, we should be seeing 5+ % increases in wages, and we're still only seeing 3% increases in wages. But it's starting to pick up, and it's starting to pick up with some speed. And what that means is corporate margins are starting to come under pressure. Very, very subtly. You can see that margins in the corporate world peaked in 2015, and they're starting to roll over. Inflation, low inflation, moderate inflation has been one of the key elements of this strong economy, allowed the Fed to be very accommodative. You can see not even 2% here for the last several years. Although when you break it down, goods minus 1%, services 2.5%, shelter 4%, medical 2%. I think a lot of these statistics are, I feel, are somewhat dubious. I don't believe that shelter is only rising at 4% when home prices are rising at 6% and mortgage interest rates are starting to rise. I don't believe medical care is rising at 2%. So it's interesting to ask the question of whether the statistics we're relying on with respect to inflation are actually really valid. In the end, it's usually the credit cycle that helps push economies into a rollover scenario. So you can see the massive increase in debt that we had over the last 30 years, the great debt supercycle that was caused partially by rapidly declining interest rates. And yes, the good news is overall debt in the United States as a percentage of GDP has declined a little bit since the peak in 2007, but it's very high on an absolute basis. So what do we need to watch out for? We need to watch out for what happens with credit. And as you can see, from very low levels, household delinquencies are starting to pick up. They're low, but they're starting to rise. And corporate debt is today the highest it's ever been as a percentage of GDP in the United States. And here's another measure of how corporate debt, these are the most speculative grade bonds, think of these as subprime bonds for corporations, they're starting to see the early signs of default and delinquency. And the US debt, as we know, is at all-time high levels, getting close to the levels that we had in World War II. And very interestingly and somewhat anomalously, at a very strong point in the cycle, we're seeing federal deficit, annual deficits rising at the time when they usually fall. This is obviously due to some of the fiscal policies of the administration. And all of that is happening from a context of incredibly low interest rates, zero interest rates, negative real rates starting to rise. The FOMC has put out their expectations of rates over the next 12 and 18 months. The market actually believes the FOMC is not going to deliver on their rate increases. That's what the market believes. Stanford's own John Taylor would say that the rates need to rise significantly more in order to keep the economy in a balanced level. And finally, this year, we're starting to see that come through in market interest rates. The 10-year Treasury has gone from 2.4% to 3.2%. That's a 1/3 rise in interest rates just in the last year. And when that happens, you see things like this. Home purchase intentions, the blue line, fall meaningfully just because of those pressures of rising rates. And as a result, the home builders index of stocks has also declined. And then, of course, there's what's going on with China with the trade war. The good news is that President Trump is probably right that in the short term, a trade war will not have a major impact on the US economy. Trade is just too small for the US at 15% of GDP. Probably we're talking about less than a 1/4 point impact on GDP as a result of the trade war and the $250 billion of tariffs that the US has imposed on Chinese imports. But the real issues I don't think are short term. I think the real issues are the longer term of how this relationship between the US and China politically will unfold. And of course, I think many of us are very concerned about that. So when will the next recession be? Well, here in the Stanford Institute of Economic Policy and Research, one thing that we can't do is listen to the economists. The economists get it wrong all the time. As you can see here, this is a composite survey of all economists that shows that it's hard to get the economists to think that there's more than a 1 in 4 chance of recession, even right on the eve of a recession. Look at 2007, 20%. Look at 2000, 15%. So we can't listen to the economists. Probably the most reliable measure has been the spread between short-term interest rates and long-term interest rates. That's the left-hand side curve. Whenever that yield curve gets inverted, 7 out of the last 7 recessions has been foretold by that yield curve. And as you can see, we're getting close to the zero line. So on the issues side, we are late cycle. There's a lot of issues that are starting to pop up. This is the result of natural human behavior of people reaching too far, taking on too much debt, same time as interest rates are rising, taking on too much risk. You can see the list of issues that we have to deal with. Wages rising and starting to build, inflation starting to build, of course, the trade war with China, high equity valuations that if they break, will cause a wealth effect and a sentiment effect. I want to take 1 or 2 last few minutes to go through the analogy that I think is most relevant to where we are today, which is not the great financial crisis environment of mid-2000s, but rather the late 1990s. So in the late 1990s and through the 1990s, we had a very similar long, steady recovery in the US. Inflation was nicely under control. Interest rates were nicely under control. There was a very good balanced sense in the economy. Technology started coming through in the mid-1990s and into the late 1990s, just as it is today. You can see in the top right-hand chart how strong the GDP growth was all the way through 1999 and into 2000. of course, the market was up 400%, and venture capital was booming. You see $100 billion of new venture capital investment in 2000. 80% of the IPOs in 2000 were unprofitable companies. The NASDAQ went from 1 trillion to 7 trillion. And then in February 1999, the Fed decided to try to cool the economy a bit. And you can see interest rates started to rise. And even while interest rates were rising and the unemployment rate was low, this is Goldman Sachs saying everything's good, economy is balanced. 16% of economists felt like there was going to be a recession coming. And then on a dime, the unemployment rate rose. And whenever the unemployment rate rises by just 25 basis points, a recession ensues. I went back to look at what you could see in 1999 that was changing before this on a dime inflection. And there was very little that you could see. On 98 out of 100 measures I looked at, the economy was firing on all cylinders. The only two I could find was profit margins were starting to be squeezed and electronics orders were starting to go down because of over-inventory. But very quickly, but by 2001, the economy rolled over, not hard, moderately. Earnings for corporations rolled over hard, even though the economy only rolled over moderately. And of course, what we saw then was NASDAQ going from 7 trillion to 2 trillion, losing 80% of its value, total drop in venture capital, total drop in IPOs. And look at where we are today with respect to venture capital and IPOs. Same as where we were in 1999-2000. At the end of the day, earnings went down by a quarter, valuation multiples went down by a third, stocks went down by 50%. After a very moderate recession in 2000, 2001, a moderate recession. There was a wild card which came at the end of 2001, which was 9/11, that aggravated things. But here's a picture of where we are today versus where we were in the late 1990s. So these cycles are natural. They happen because of human behavior. A strong economy leads to very low unemployment. Wages start to rise. The Fed starts to raise rates. Credit starts to tighten. Investment in production slows, et cetera, et cetera. And once that negative loop starts, it feeds on itself. And there are wild cards. I talked about September 11th, 2001. Maybe the wild card is what's happening in Saudi Arabia. Maybe the wild card is happening politically here in the United States. I'm not sure, but there are always wild cards that you can't predict. So we have to keep these two opposing thoughts in our mind. A really healthy economy will lead to a rollover in the economy at some point in the next several years. My crystal ball, for what it's worth, and these slides are from about a month ago or 6 weeks ago, volatility will increase, stocks will peak in the next year, the economy will slow in 2019, and we'll have a moderate recession over the next couple years after that, probably 2020. Market will go down at least a quarter, because that's just human behavior, and that's what happens with economic cycles and human cycles. So with that, we can talk about California.
Thank you for inviting S&P to present here today, and myself personally, I'm honored to be able to participate in today's forum. And I thought it is useful to begin with a brief bit of context about how we do our work at S&P in the credit ratings world. And as a credit rating agency, we do provide ratings and credit opinions and analysis across almost virtually every debt instrument in the fixed income markets. The broad categories are here shown on the slide: financial institutions, corporates, insurance companies, et cetera. And I work in our U.S. States group, and so we are in the U.S. Public Finance Department. And within public finance, there are also a wide range of debt instruments and security types that we rate. So you can think of school districts, cities and counties, special districts, library districts, water and sewer utilities. There's a long list. In fact, we have, all of our ratings are done according to published criteria. It's actually a matter of regulation. We must follow consistent criteria for each type of debt that we rate. And so in public finance, we have upwards of 30 different criteria frameworks, if you will. And for the states, there are a lot of factors that we consider, and but I can put them into 5 broad categories. They are the economy, the governmental framework or institutional setting of the states, financial management, budgetary performance, and then the debt and liability profile. When you put all of this together, the state sector in the U.S. is a highly rated credit sector, not just within public finance, but across all of S&P. And I think you'll see there's some overlap with what Michael said earlier and what I'm about to say. Some of the benefits or advantages that states have are really institutional in nature. First of all, the states operate in a constitutionally protected setting where they're allowed to set their fiscal policy in accordance with their own political culture. And so we see some states that are higher tax and higher service, and some states vice versa. And really, the federal government does not put any prohibitions on state tax policy, aside from interstate commerce. And so that provides them with a lot of latitude to, unlike a corporation, the states set tax policy and collect revenues with the force of law behind them. So they have a pretty powerful, apparatus. The second thing, and Michael talked about this, is the federal government, the fiscal union that the states participate in the United States. Now, Michael talked about it as a risk, and I think you'll see that the way I'm talking about it here, it's the other side of the same coin. It's a huge advantage from a credit standpoint to have these federal transfer payments that go into the state budgets. And in particular for Medicaid, which makes up more than half of the total federal transfers that the states receive each year, it has a counter-cyclical dynamic to it. So when people lose jobs and their incomes go down and they qualify for Medicaid, certainly the state loses tax revenue because of the recession, but at the same time, the states receive an influx of federal transfer payments that support those people's Medicaid enrollment. And so from that standpoint, it has a cushioning effect on the federal government. And we've been writing a lot about the risk that Michael talked about if there were a change to that arrangement. Then the third advantage that the states have from a credit standpoint is really that they've evolved to a relatively conservative credit culture, at least from a global perspective. And we talk in municipal finance, we talk about how the last state that defaulted on its debt was in 1933, and it was Arkansas. But actually before that, in the mid-1800s to the latter part of the 1800s, there were several different waves of state debt crises. And in response to those episodes, the states went about enacting these constraints on themselves, balanced budget requirements, limitations on how much debt they can issue, and the requirement to get voter approval for certain types of debt. And those things all were done to assuage the capital markets and investors so that they could maintain access to capital markets. And so those factors have all benefited state credit quality. However, there's been an unusual development throughout this economic recovery. Jonathan talked about the slow pace of growth, 2% GDP growth per year. This has been a real source of fiscal strain for the states, and you can see that over the course of the recovery, the credit quality of the states has actually deteriorated. Now, states tend to be fairly pro-cyclical, and so they improve when the economy is doing well, the tax revenues increase, and those cost pressures related to Medicaid, for example, go down. But in the slowness of this recovery, state tax revenues have recovered at a very slow pace. And so this is similar actually to, there's a high correlation between tax revenue growth and GDP growth. States tax current economic activity, unlike local governments that tax properties or assets. So income and sales tax and corporate earnings are all current economic activity. And you can see here that this is indexed to the beginning of each of the past 4 recessions. State tax revenues have recovered at a slower pace in each of those recessions, with the slowest being the most recent. And so that has really weighed on the condition of state budgets. The other thing that has happened is, Michael talked about this also, you foreshadow my remarks here, that the states have, not just California, but the states have evolved to a more service sector economy. Most of the state tax structures, and California is no exception, the tax systems were designed in the first several decades of the 20th century, so 1920s, 30s, up through the 50s. And so when they established the sales tax structure, it mostly applies to tradable goods, tangible goods. That was the driver of the economy back then. And as the economy has become more service sector oriented, there's been an erosion. And you can see this, the red line is what Michael was talking about. It's the sales tax as a share of general fund revenues. And you can see that it used to be around 60% of the budget, and now it's only about 20%. And in its place is the blue line, the increased personal income tax. And with that trade-off comes an increased level of fiscal volatility. The revenues are much more volatile. Then the third item that contributes to that negative tilt to the balance of rating actions has to do with what states pay for. Most of what states pay for are health and education. And the service sectors, I'm sure some of the economists in the room are familiar with Balmer's cost disease. The service sectors are not very good at reflecting productivity gains in their cost structures. So there's a higher rate of inflation in these services than there is in other sectors of the economy. As a result, or one of the reasons, or one of the consequences of this is that Medicaid costs and education, but here I'm showing Medicaid costs have risen faster than state tax revenues. And there's another demographic component to this as well, and that is that as the population ages, that's also independent of the economic cycle, and it's putting upward pressure on Medicaid expenditures. The Department of Health and Human Services published the Medicaid actuarial report and said that only 8% of the enrollees in Medicaid are elderly, 65 and older, but they consume 16% of all the Medicaid expenditures. And that's because Medicaid covers long-term care, whereas Medicare does not. So that's a long-term source of pressure on the states. And the other source of pressure on the states is something that we've already begun talking about, which is pensions and retiree health care for state employees. So this slide basically shows and if you add debt service, pensions, and retiree health care, that's what we at S&P think of as the fixed cost of the budget. And those fixed costs, California is a little above average, but above the median, but actually toward the bottom end if you fold in Medicaid as well, which I'm including it's a non-discretionary budget item. And I think what you could take away from this graphic is just that these bars are going to continue to inch higher as the population ages and as that higher rate of inflation continues to assert itself in these components of the budget. Now, one of the things I wanted to go on and say is that the states have just almost to prove my point about the correlation between economic conditions and state fiscal health, the state finances have really stabilized in the past 12 months or so. And it has to do with the uptick in GDP growth and the influx of revenues that they've had. And so whereas many states were facing budget deficits before this time period, they're now facing a balanced outlook. Now, Mark asked, what happened to those deficits that Michael was talking about? This is one way to think about it. This is looking at the state's general fund balance sheet. And so throughout the course of the first decade of the 2000s, you can see that it was accumulating a negative fund balance position. And that largely represents the audited capture of the wall of debt that Michael referenced. To us, the key thing is to note is that the state kind of came into this time with a structural deficit already present before the recession started. So you can see that it's negative in 2007. And so to piggyback, far be it for me to add to what Michael says, but nevertheless, to add to what Michael said, the state did implement some fiscal reforms. I did a look-back analysis, and this shows what the Legislative Analyst Office was projecting in 2010. The blue line is the expenditures that the LAO is projecting at the time. The bottom two lines are the actual expenditures. And so if you compare the 2016 actual expenditures to what the LAO is projecting in 2010, they're 11 billion lower. So the trajectory of expenditures was brought down. On the other hand, revenues were brought up. And so whereas the revenues are higher now by $9 billion than what they were expected to be back in 2010. And the LAO, if you strip out what the Proposition 30 taxes provide, you can see the green line, that's what I showed there. The LAO's forecast of revenues at that time was fairly accurate. It was only off by about $1 billion. So what were the results? Well, since they put those changes in effect, the audited financial statements for the general fund show an improvement in the fund balance position for the state's, on the state's balance sheet. And this goes to the final point about the volatility that California is subject to. We did our own stress test. I was happy to see the $20 billion reference because I think we had similar economic assumptions, and when we ran our numbers, we estimated that the state could fall short of its revenue forecast by 19.5 billion, which you can round to 20 and say that we were right on the mark with what the Department of Finance said. So what we think this means is there's going to continue to be a premium on fiscal management at the state level, and if you go back to the beginning of this year when Governor Brown had his press conference and introduced the proposed budget for fiscal year 2019. There was a reporter that asked about, well, what do you recommend for the next governor? What should the next governor do when he's or she is managing the budget? And his response is one of my favorite quotes that I repeated to my rating committee and I've said to other people is, well, out there is darkness, uncertainty, decline, and recession. So good luck, baby. And the reason I liked his comment was not because it was so pessimistic necessarily, but because he had his eye on the ball. And I think that that's been demonstrated throughout the governor's administration, and it has led to an improved credit rating for the state. The state's credit rating is currently AA-, which is a little below average, and I think the below average aspect of it reflects some of the concerns that people were voicing in their questions. So we try to balance all of those, and that's the result. So with that, I'll stop my remarks.
Well, thank you both. I think that was great and really paints the picture for what conditions are like right now and how California could be affected. So Jonathan, you mentioned that conditions today look very similar to conditions in the late 1990s, and presumably the type of recession that we might face is maybe similar to that. What does that tell us about kind of the likely impacts of a recession if one hits relative to the recession that we just experienced?
Yeah, well, as I was mentioning, I think the great financial crisis was caused by the worst type of problems. It was a house-led, home buying-led, mortgage-led, bank-led set of financial problems. And since the house is everyone's biggest asset, since the mortgage is their biggest liability, since it's bank's biggest assets as well, when that goes in the wrong direction, it really ripples through the economy very, very strongly, as we saw. But we don't have any of those types of imbalances right now. What we have now is more of just a natural, strong economy. We're seeing some imbalances in certain parts of the credit area, and we're seeing some imbalances in the technology area. So I think we can anticipate a relatively moderate recession that feels a lot like what was happening in 2000, 2001. And maybe we won't have the wild card of September 11th or some other wild card that would push it down even further. I think we can anticipate something like the late 1990s.
So Gabe, what features of California's economy make it, and our population and demographics, make it particularly vulnerable to a national recession? And are there any safeguards in place that could soften the blow?
Well, the state's economy, I think, is top-heavy in the sense that there is a high level of income inequality, and so there's volatility. And it's not, just the disparity that's an issue, but it's the source of income. I mean, we've already talked about it here today that the top taxpayers pay a disproportionate share of the revenues, and they tend to be highly cyclical. And so there are some safeguards in place that I don't think always go fully recognized. When the revenues go down, the Proposition 98 funding formula that was talked about earlier also computes out a lower minimum guarantee, as it's called, minimum requirement for the state to pay. And so there's sort of an automatic stabilizer built into the state's finances. Now, mind you, that would impose a fiscal burden on the school districts, but there are a lot of provisions like that embedded in the state's budgetary structure. And I think to a significant extent, the policymakers over the last several years have done a lot to address the symptoms of fiscal volatility with the rainy day fund and setting aside, actually even more money than was required under the law, Proposition 2. And the other thing I just would want to mention is up until 2010 or 2011, the state required a 2/3 majority in the legislature to pass budgets. And if you remember, when they were comparing California to Greece and in those times, the state was a perennially late budget adopter, sometimes months or more after the fiscal year began. And since then, even when the state was facing a $27 billion deficit, Proposition 25, which allows the legislature to pass budgets with a simple majority vote, has resulted in timely budgets since then. And I don't think you can overstate the importance of having a budget in place just for the policy implications of it, but also the cash management of the state and its overall fiscal position.
And Jonathan, Gabe brought up the kind of the change in the service industry over the last 19 years. And Jonathan, do you have anything to add about kind of the sectors that we see represented in the state and what that could mean for the recession?
Well, I think the good news is that California has gotten increasingly more diversified over the last 25 or 30 years. If you think about the different parts of the state, sort of generally, in the South, you have defense, you have entertainment. In the middle of the state, you have agriculture. Here in the north, you have technology, finance, banking. We have healthcare throughout the whole state in very, very strong ways. So I think the good news is the state is more diversified than it's ever been. So I think that's really helpful. I do agree that one of the big challenges is so much of the state income tax revenues comes from such a small proportion of the citizens at a time when both high-earning citizens and the wealthier corporations are asking themselves whether this is the right place for them to reside.
And how have, the recent, can you speak to a little bit of how the recent federal tax reform has also kind of exacerbated that?
Yeah, absolutely. I think, at this point it feels a little bit like mostly chatter, but I think you are seeing more and more individuals and more corporations asking themselves, do I really want to have this type of tax burden? Maybe I should move to Nevada or Colorado or Arizona or some of the other beautiful states here in the West. So I think it's happening, and it will be worse when people don't feel and corporations don't feel as flush as they do now.
So Gabe, in a recent report by S&P Global Ratings, you ranked California as one of 15 states with elevated risk in terms of its susceptibility to fiscal distress in a recession. So can you speak a little bit about what factors contribute to that maybe weren't part of your presentation, and what are policies that low-risk states have that California could potentially adopt?
Well, we looked across 3 dimensions. One was this propensity of a state's revenue system to be volatile, the size of its budgetary reserves relative to what we calculated as the estimated revenue loss that they could experience, and then the third was the level of their fixed costs. And for California, the volatility is very high. It's one of the highest in the nation, so that put them in that category. Its budget reserves, while they're at a historically high level now, they still are not sufficient to even cover 1 year of revenue loss that could occur in a moderate recession. So it's a daunting story there. And then third, the fixed costs are, they're 13% of the state's expenditures, and that's the median for the states is 11.5%, so they're above that, which put them in kind of a moderate range for that, but you add those together and we put them into the elevated risk category. To answer the question, it's the states that have the opposite of those characteristics: low revenue volatility, reserves that are sufficient to cover the loss in a recession, at least for 1 year, and then lower fixed costs. And some of those things are very difficult to change as a matter of policy. It's difficult to overhaul a state's tax system. The budget reserves are certainly a policy that can be pursued. The fixed costs are also something that move very slowly. We've talked about the pensions, and so sometimes doing the right thing with pensions, such as assuming a lower investment return on your assets, if you lower it from 7.5% down to 7%, it actually increases the measured liability, which then requires a higher annual contribution from the budget. So from a budgetary standpoint, your fixed costs go up when you take that step. And the governor has, under his administration, they have brought down the fixed costs related to annual debt service because the state has been more restrained in its issuance of new long-term bonded debt. But even that has come down gradually over the years. But it has come down every year since 2013 as a share of the budget. The state's expenditures for debt service have declined.
Gopi, one of the things that I wanted to also mention along these lines is the emphasis on technology is so amazing, and we're all benefiting from it. But it also is a double-edged sword for the corporations. We're all really proud that we have Apple and Google and Facebook and Intel, et cetera, here. There's 300 unicorns today in the United States, the vast majority of which are based in California. A unicorn is a private company with a market value of over $1 billion. There's 300 unicorns with almost $1 trillion of value. And putting that together with this issue of the capital gains contribution to the budget, you don't even have to have significant downturn in equity value for the capital gains. You can just have not an increase and not selling at high levels to wipe out a lot of those capital gains revenues that are going into the state budget. But if you did have a downturn and that $1 trillion of unicorn value gets cut in half, the ripple effect through the housing market, through the job market, through the sentiment of that part of the economy will be very, very high, like we saw in 2001 and 2.
Well, so I'm going to ask one more question and then turn it over to the audience. So it was talked about in the previous session and in this session just how much ballot initiatives and propositions kind of contribute or in some cases help California's position or California's ability to sort of withstand a recession. And, you know, as a voter and someone who was looking at the ballot relatively recently, I noticed that the current ballot initiatives are required to provide the fiscal impact of the proposition, but they don't necessarily say anything about how it might improve or take away from some of the stability in California's economy. And do you think that there's any scope or any benefit from requiring some kind of analysis of propositions on their effect on volatility in terms of the state finances?
Well, the fiscal impact analysis is useful, but one thing I think about is we already ask a lot of our voters in California to try to basically make law through the voting process. And those estimates, so for example, Proposition 5 is on the ballot this year, and it would expand the ability of homeowners to transfer their current assessed value to the new home they buy. And it comes at a cost, though. If you're not reassessing the new property that they buy, there's less revenue coming into the local school. Property tax is a local tax revenue, it's primarily for schools. So you do that, and the impact analysis is that it will cost $200 million of increased cost to the state general fund to backfill the missing property tax revenues to the school districts. But that's going to increase to $1 billion over time, it says. So that, you could say, in my view, could increase the instability of the state's budget or through something like that. So maybe adding that kind of point is what you're getting at, and it could be helpful. I don't think when people passed Proposition 13 in the late 1970s, it was so much thought about that one of the effects of it really would be to centralize in Sacramento the funding of many local government services, including schools. And so, you know, in doing that and shifting the reliance to the state and to the general fund increases, therefore, our reliance on the income tax, which is, as Jonathan was just saying, I mean, it's very, very susceptible to that volatility. So I think that's not a bad idea, Gopi.
All right, well, we have about 7 minutes left for questions. And yeah, in the back. Yeah.
Hi, just 2 questions about the potential role of fiscal policy in the next recession. One of Jonathan's slides showed that we're in this unusual situation where the deficit is increasing at this stage in the economic cycle. So, first question is, to what extent could that fiscal impulse turning into a drag in the next couple of years be the catalyst for the turnover in the economy that you mentioned? And then second, fiscal policy was very important in responding to the last 2 recessions. We had massive increases in the government deficit in 2001 and after the global financial crisis. Does the fact that we have much higher levels of debt now reduce the fiscal space for the federal government to play the same role it's played in the past?
And I think the answer is you're 100% on the money, both on the fiscal side and on the monetary side. You know, this recovery was sparked by very significant fiscal stimulus in 2009 and 10, very significant monetary stimulus throughout the last 8 or 9 years. Interest rates are not yet high enough for us to be able to drop them very much when the next recession comes. We have a very large balance sheet, $4.5 trillion balance sheet at the federal government, which is hard to expand, although I suspect that in the next recession, the Fed will go to the same playbook of quantitative easing, massive quantitative easing. That will be the playbook since it worked this time. But on the fiscal side, as you say, we're going to have $1 trillion fiscal deficit next year. We're going to be running 7-8% of GDP at the high point in the cycle. And at some point, we would think that our politicians would say enough is enough.
I just would add one quick thing to that. We think that the risk that the federal government presents is one of the major wild cards when you look ahead at state finances. In the last recession, there was approximately $400 billion of total aggregate fiscal deficits in the 3 years, 2009, 10, and 11. And the stimulus bill provided, in addition to the economic support, it provided $163 billion of direct fiscal aid to the states in those same years. So it's more than a quarter of the deficit. The overall deficit was backfilled by federal funding. And if the federal government is not in a position to do that the next time, I think in addition to the economic implications, the states could really feel the pain.
Wall Street Journal did an interesting but somewhat devastating piece about 1.5 years ago about the federal cost of medicine and what it consumes of the total tax intake. And at the time it showed that about 60% of the total collections of the federal government were being redistributed in the form of medical services through through all the departments of the federal government. Now, if you run out the numbers on that, it puts medicine consuming 100% of federal collections by 2025 at a 5% increase at the time, thus squeezing everything else into debt financing. How much risk does that present? Because it not only affects the federal government, it affects every state in the union as a high-risk proposition.
Well, I think the short answer is, as Secretary Schultz mentioned, we have a system that doesn't work. The incentives aren't aligned between the consumer, i.e. the patient, the supplier, i.e. the doctor, the middleman who's being paid by the employer. It doesn't work. We have an aging population. We have more and more technology that's very expensive. And we have not been willing to make the choices that other countries have made on things which are on the margin, discretionary. I don't know the stats off the top of my head, but I do recall that some very large proportion, maybe it's 1/3 of all medical expenditures, Mark probably knows it perfectly, are spent in the last 6 months of life. 1/3, and we're spending 20% of GDP on healthcare, and it will continue to rise at a rate well in excess of GDP. So the problem is real. The Medicare system needs a lot of work, and I think it's a big risk.
Question right here.
Assume that the incoming administration in the state believes your views, Jonathan, about the probability of a recession and the likelihood that that will come with substantial capital gains losses for volatility for the state. What would be the top 1 or 2 things that you would each suggest that he pays attention to ensure if we know it's coming, we're more ready?
Well, I think that the next administration has to continue the focus on multiple-year fiscal planning, retaining a balanced fiscal alignment between recurring revenues and recurring expenditures. They need to heed the quote I gave of Governor Brown at the press conference in January about the coming recession. We don't know when exactly, but we know it's coming. And the thing that the state did in the past, before in the first decade of the 2000s, was repeatedly overestimated revenues, looked those as, recognized those as being able to fund ongoing expenditures, and then the shortfall would accumulate in the debt that became the wall of debt. So, I think it's a qualitative response, and that's why it's actually one of the reasons why our rating, we think if the same fiscal policies could be assured to be in place going forward, we would have a more positive view, but we're uncertain of that at this time.
I guess the only things that I can think of on the expenditure side, I mean, I'm sure there's tons of waste in the expenditure side, but I think the real issue is on the revenue side. What I mean by that is we're really lucky to have $3 trillion companies right here in our backyard in Google, Apple, Facebook. We're nearly $1 trillion companies. If the state chases away great corporations and high-earning folks, the whole system will sort of fall apart. So I think it has to be geared towards keeping the state to be business-friendly. That means everything from affordable housing for the folks that work at these places, back into the state university system that we all know is under a lot of pressure, because that's the engine that drives all of this. If you lose Google, if you lose all the high earners here, your revenue is going to go down by a third over the long run if you lose that. So that's where I think they need to focus.
Great. We'll take one last question and then we'll break for lunch, and I have to give some logistics before we do that. So.
Howdy. As somebody who runs an economic institute, I'm often the skunk at the garden party, but I think today I'm going to be the garden at the skunk party. There's been a lot of essentially negative talk about California. I'm not sure that we're really accounting for the economic dynamism of the state and the sort of long-term assets that it has in places like, to pander to the audience, Stanford University, right? And so I'm just wondering if you really feel as if that economic dynamism is well accounted for in the creditworthiness models that you're putting together.
Well, what I can tell you is operating under the framework that we have, which I said I gave myself an out, we have to, we're required to. But under that model, we've increased the state's debt rating 3 different times throughout this recovery, which is more than any other state in the country. And so I think a lot of that has to do with what you're talking about. If you read what we write about the state's economy, it's pretty glowing. It's just that that's not the only factor that goes into the ratings, and so some of these volatility issues come to bear, as well as the long-term challenges that it faces with the liabilities on pensions, retiree health, and the deferred maintenance backlog, all of those things, climate change. There are big challenges out there that remain risk factors that are separate and apart from the economy itself.
And I think it's just a matter of complacency. So California is amazing. It's an amazing state, not just economically, but from a natural beauty perspective, everything. That's why most of us love living here. But it's in times like this where you can't get complacent. You have populism and political and social forces which are doing things like having a proposition a few years ago that says, hey, who would like the top 1% of the earners to pay another 300 basis points of taxes? All these things that feel good in the short term have unintended long-term consequences. So it's just a time not to be complacent. It's a time to double down on pushing those things as opposed to getting populist and pushing them away.
All right, so before we thank our panelists, I just want to give a few announcements of what is going to happen next. So there are box lunches available at 2 tables, one in the lobby and one outside. You can go out the back doors here to access the lunches in the back, but you need to enter back through the lobby, and everyone needs to have a name tag on during the lunch session. We're going to come back to this room, and we're expecting a full house for Governor Brown's keynote, and that will start promptly at 12, and no one will be let in once the doors close at 12 o'clock. So just take that into account. With that, I'd just like to thank everyone for attending the morning session, and especially our 2 panelists. So.